Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A third bullish white soldier yesterday and a suitable follow-on higher to the previous session's key reversal up. The market broke up clear through its very recent cap, the congestion area 104.92 to 104.51, which has both the February and March lows at the same 104.92 number. It also managed to punch up over the April 2017 low at 105.68, but halted ahead of testing the declining middle time, currently 106.26, of the January to May 2021 bearish Andrews pitchfork. This pitchfork's amazing. It has run this bearish market now for well over a year. We ended up closing just under the April 2017 low. Overall, we are still in between the declining middle time above, currently 106.26, and the lower time below, currently 102.55, of that January to May 21 bearish Andrews pitchfork. So far today, a retracement back down to sit on the congestion area 104.92 to 104.51. Right now, we're either looking at a reactionary bearish harami today, if only just, maybe a tweezer top possibly, I'm not even sure about that one. Cable, aka sterling against the US dollar. Second bullish white soldier yesterday and a more than suitable follow-on to the previous session's bullish engulfing pattern. It was also a second consecutive significant close back up over the May 2020 low at 120.73 and a first close back up over the June 2020 low at 122.48. This move back up was very interesting. You see, it seems that the market possibly took fright at the enormity of the empty space below the May 2020 low and reverted back up. It doesn't mean that the attempts low are over, just that the market has gained some perspective of the situation on the downside. I've taken this opportunity to draw a fresh bearish late April to late May bearish shift pitchfork. Currently, prices are in between the upper time, that's 124.31, and the middle time, currently 120.92. Recently, I have put forward the ideas that the action since late April to date is either a possible double bottom or a bearish halfway hesitation. It looked very much like, with admittedly only a single significant close under the May 2020 low, that it may well be a big bearish halfway hesitation. But it is early as yet, but it's enough for me to give an initial target X in the 117.50 area if this pattern develops. So far today, a reactionary move back down, but it halted its decline by the June 2020 low. I suspect that today is moving towards a possible bearish dark cloud cover pattern type, or maybe a tweezer top. Euro sterling. A second bearish black Maribozo yesterday, and a suitable follow-on lower to the previous session's combined bearish harami and bearish long black Maribozo, and the recent also pipe top. Well, the market dropped down through the neckline, currently at 85.65 of December 21 to May 22 reverse head and shoulders pattern. This support is the extension of the rising upper trend line, of the original and extended diamond pattern. Hence, a close below it was important. The market went further and dropped down through the mid-April to date uptrend, currently at 85.31. However, it could not maintain this push and ended up closing back up over this uptrend. Now, prior to the recent pipe top, we still had the following targets on the upside. For the smaller lopsided diamond pattern, we had a primary target X in the 86.80 area and a harder to get secondary target X1 in the 87.65 area. For the extended diamond pattern, we have a primary target X2 in the 87.15 area and a harder to get secondary target X3 in the 88 even area. Okay. For these two diamond patterns, both primary targets, target X in the 86.80 area and target X2 in the 87.15 area, well, these primary targets for the original lopsided bottom, diamond bottom, and extended diamond bottom, respectively, have been reached. There are two additional items to discuss. There is the previously mentioned big one, which has been triggered, but then the market has sent mixed messages. I've spoken for months now of the very large falling wedge pattern, currently 84.51 to 81.35. This pattern is still in operation, but it has fallen into the shadows a little with the rising prominence of the diamond patterns. And though triggered, it still leaves us with some serious questions. You see, it has the most ambitious upside target of all. Target X4 for this pattern is in the 88.65 area, and that is a really big ask. More recently, with the previously mentioned neckline, currently 85.64 of December 21 to May 22 reverse head and shoulders pattern. This support now, today acting as resistance, is the extension of the rising upper trend line of the original extended diamond pattern. A primary target X5 for this reverse head and shoulders pattern will be in the 87.75 area, and a secondary target X6 would be in the 88.60 area. Targets X4 and X6 are currently just off the top of my daily chart. So far today, well, a sort of a reactionary move back up, but capped by the neckline and supported by the uptrend below. It seems the market's getting squeezed right now between the neckline above and the uptrend below. US dollar against the Indian rupee. A reactionary bearish black crow yesterday, which could also be seen together with the previous session's bullish white soldier as day 2 in a 2-day bearish separating lines pattern. We'll have to see if it works or not in the next few sessions, though I would remind you of the bearish belt hold here made last Tuesday. The move down yesterday was halted by a combination of the interesting recent congestion at 77.89, as well as the broken lower trend line, the recent ascending triangle, currently 77.93. A little further down, we also have the breached but formidable lower time, currently at 77.85, of the mid-January to mid-April bullish Andrews pitchfork. The market is similarly now resting on top of the recent congestion zone between 77.40 and 77.80, despite these recent bearish patterns. Meanwhile, overhead is the old target X in the 78.30 area. This was the target for the whole of the 2022 action, being a ragged bullish halfway hesitation. It was reached this past Monday. And so far today, well, higher opening and a further attempt higher as the recent bearish daily patterns are promoting a limited reactionary action in the market. For example, we have a bullish pattern today right now, but we're still capped by yesterday's high. US dollar against the Brazilian real. A bearish engulfing pattern on Wednesday, which wasn't that hard, as the previous session was an indecisive doji cross. However, it could also very well be day 3 in a 3-day bearish evening doji star pattern as well. We'll have to watch today and Monday's action to determine if that is so. The market dropped down and closed below some interesting Fibonacci congestion at 505.73, 507.39 and 510.87. If only just below on the first one. Further down, we now have support from the following: the 50% Fibonacci line of the October 19 to May 2020 move at 496.58, and the declining medium moving average currently at 496.14. Meanwhile, further up, we have resistance now from the middle time, currently at 516.63. Of the newly drawn April to late June bullish Andrews pitchfork. This is the first contrary bullish Andrews pitchfork I have drawn for quite some time here. Above the middle time, we even have more resistances at 519.41 and 520.27, and then the high for May at 520.95. Just above these, we have the start of some significant resistances. They are the 50% Fibonacci on the March 21 to April 22 move at 522.76 and a slowly declining long moving average. That's currently at 525.12. It is worth remembering that the recent high here back in May only managed to get as far as 520.95, but then again, I should point out that this move is starting from a higher base. Indeed, we could look at the action since the start of April as a possible bullish halfway hesitation, if not a perfect one of those. This would have a limited target X on the upside at 528.45. I'm not altogether sure on this one. Not yet. US dollar against the Mexican peso. An immediate countering bullish harami after yesterday's large combined key reversal down and bearish engulfing pattern. As I said yesterday, this seemed the end, or at least a pause, in the dramatic run-up we've seen since last Thursday's interesting and somewhat out of the blue key reversal up an earlier shooting star pattern, type 2 bullish. Yesterday, the market made a second attempt on the upside, but it was rebuffed, again, by the following combinations. The 61.8% Fibonacci line of the July 17, April 20 move at 20.60.62 on a closing basis, this one. The 50% Fibonacci line November 21 to March 22 move at 20.78.02. And the upper time of, well, it's currently at 20.76.02 of the newly drawn November 21 to March 22 bearish shift pitchfork. Prices also seemed uncomfortable again, sitting over the neckline, currently at 20.54.55 of the September 21 to February 22 head and shoulders top. This ties in with my recent warning that before we get all too carried away with it, it's worth remembering that we've been up here before back in late April, and the market at that time peaked just over the lesser 61.8% Fibonacci line at 20.60.62 before dropping down. Hence, it paid and pays to be cautious here. This time, the flatlining long moving average, currently at 20.41.49, provided the closing resistance with the declining medium moving average, currently at 20.21.83, providing the support. What is perhaps the most extraordinary piece of action from yesterday was how the high and low matched the previous session's high and low, yet there was no bearish double or bullish matching pattern. The long moving average's closing pressure on prices made sure of that. Looking elsewhere, for the moment, I'll keep the bearish broken Andrews pitchfork on my daily charts. I think it ties in well with the new pattern I've indicated, pattern indicator I've drawn. The previously mentioned shallower bearish shift pitchfork for the same move as the Andrews. These two pitchforks have had crossovers recently on Friday the 3rd of June and recently on the 10th of June. That's also a Friday. You can see them circled on my daily chart in red. This ties in with what I know of such crossovers. So, on or soon after a crossover, you will have one or more of the following likely to happen: market volatility, a change in trend, or a reinforcement of an existing trend. In these cases, the third was a change in trend, and the 10th of June was a reinforcement of a trend. Now, so far today, prices have pushed up over the long moving average, but the rise has been limited and they've dropped back down again into the main body of yesterday's action, though not as far as the medium moving average below. Right now, it is beginning to look like a bearish dark cloud cover pattern type, though it is still early. Thank you for listening. The short version broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Tofpik and ADM Invest Services International Limited. And here comes the final bet.